Now, India's October CPI inflation has come in at a record low of 0.25%, in line with the CNBC-TV18 poll. The drag came largely from food prices, but would this mean a rate cut from the RBI in their next policy? Latha is joining in with more on this. Latha, good morning.
Well, let's first take a look at the numbers. 0.25% is an all-time low for the new index, CPI index, which started in 2013. But even if you go historically to the last 70 years of Indian CPI numbers, this will be some kind of a record low. The culprit, as you pointed out, is food CPI at minus 5.01. Our poll was minus 4.1. So many people were expecting it, but it was lower than even the market estimates. And with this, the food CPI is negative for the 5th straight month, which means it is lower in year-on-year terms, what we call deflation. And it is likely to be that way for the next 2 months, according to analysts. The CPI for the full, the reason why the inflation is coming down is because even in month-on-month terms, cereals, pulses, milk products, spices are all even. October is lower than September, which is a little unusual because October was Diwali month. One would have assumed much higher consumption. And usually cereals and vegetables start falling from November. In this case, it started falling earlier. And then now from the RBI point of view, the CPI has been under 4% since February. The only month when CPI was above 4% this whole calendar year has been January. And it is likely to remain under 4% for at least another 6 months, according to most economists' forecasts. Now, what this means is the Reserve Bank's mandate, the MPC's mandate, is to keep CPI at 4% plus or minus 2%. Like we told you, it's some 18 months of under 4% that we are looking at continuously, and under 2% for probably, 4 or 5 months, maybe even longer. Therefore, the expectation is that Reserve Bank should cut when it meets on December 5th. But between now and December 5th, there is another big data. November 28th, we get the second quarter GDP data, which almost everyone on the street expects will be above 7%, and some economists believe will be above 7.5%. Now, do you go and cut when growth is so strong, the first half average number coming in at 7.6? Will the Reserve Bank say that I have space to cut, but is there a need to cut? Could that, be a dilemma that the MPC faces and therefore a cut doesn't come? But at the moment, the majority is tilted in favor of a rate cut, and that can be immediately negative for bank stocks. Of course, positive for real estate, durables, etc., but negative for banks.
Latha, thank you for that detailed breakdown of the CPI numbers and, of course, the impact on the RBI subsequent action as well. Take a short